This is Todd Horowitz coming to you from the floor of the CME Group in Chicago. And as we continue in our education through this semester, what I want you to take a look at is I want you to look back and take a look at the last bit of jobs information. We had a jobs report last week, and of course we had a market that decided that it was time to go down about 300 points, and since that point the market has rallied over 1,000 points on what we would consider really pretty bad news. So when you look around and you look into the economy, you have to ask yourself, is the market driven by fundamental news or is it driven by technical analysis? And the overall picture will tell you that when we look at markets, you want to look at them from a technical aspect. Looking at a market from fundamental look is simply one thing. You want to buy companies because they are strong fundamentally. But because a company is strong fundamentally doesn't mean today is the right time to buy. You have to make sure that the technical analysis that you have done will then meet up with a stock that is strong fundamentally. And to give you just one quick example, if we go back to the year 2013, when Apple was trading at $700 a share for the first time, they had just come out with record earnings and everything was great. The biggest earnings report ever in the history of the street. And of course, Apple went from $700 to $350 a share. Think to yourself, what changed fundamentally? And the answer is nothing. What happens is as you follow and you read your charts, you're looking for areas of support and you're looking for areas of resistance to be able to consistently trade a market. So when you look at a market, you want to find or locate investment opportunities through fundamental data. But when you trade them, you want to trade them through technical analysis, because at the end of the day, technicals drive the market. Now, right now, the markets are moving in an exuberance way, or irrational exuberance, and there's one of the greatest, well, I don't think he's one of the greatest economists, but one of the most well-known economists, John Maynard Keynes, made the simple statement that markets can remain irrational longer than you and I can remain solvent. And that's, I think, what we're seeing in the markets today, is that we are seeing a market that is being very irrational, because what's happening here is that the average investor is doing what we call chasing the yield. And yield is the money. When you put money, like in a bank, you should get some sort of a yield. When you put money in a stock, you're looking for growth to maintain a yield. So if you invest $100, you're looking for that 100 to turn into 120 and then 150 and so on. So right now we have the overall chase for yield. We have a market that is totally irrational, that is trading up on bad news, but because of the bad news, that keeps the Federal Reserve and interest rates very low, making the markets want to jump higher. So when you think about it, let's just go back and recap. We want to buy or sell based on the technical analysis, not the overall fundamentals of a company. We want to have good companies that are solid fundamentally, but overall, we want companies that have good technical aspects for us to get in. So if we find a good company that's got sound fundamentals, that's come to a support level, that is the time to look in and buy. So that will be what we'll be looking at today. This is Todd Horowitz coming to you from the CME Group in Chicago.